Good morning and a warm welcome to everybody attending this second webinar. It is my pleasure to be hosting InnoRate's Getting Investment Ready, an interactive Q&A session with Fadi. My name is Edward and I work for the European Business and Innovation Center Network in Brussels, Belgium. We are one of the implementing partners of the InnoRate's project. And today I'll be your moderator. As always, we definitely have quite a lot of content and elements to go through. And really, when preparing the session with our expert, Fadi, we really wanted to give as much time as possible for the Q&A session. And this is one of the main reasons why we sent you an email beforehand in order to collect all the questions that you had so that we could really tailor the Q&A session to your specific investment-related needs. All right, so I suggest we get right to it. A quick introduction regarding the GoToWebinar interaction tool for those of you who are not aware with the GoToWebinar platform. Please remember this is a really an interactive session, so we look forward to a lively discussion during the Q&A session. You may send us all your questions via the question box on your screen. Today's agenda. As you may see from the slides, we have a packed agenda. We'll start off by introducing InnoRate as a project, after which we'll sort of delve into the different barriers that are currently being faced by highly innovative SMEs when trying to grow and scale their business. After which we'll introduce the solution that InnoRate brings to the table, so the service platform. And then it's on to Fadi, and Fadi will give you some tips and tricks on how to get investment ready. He'll introduce the different startup funding stages, what makes a venture attractive to investors, and how to really present your company to investors, which is fundamental nowadays. And then we've dedicated quite a significant amount of time to the Q&A session. And we'll start off the Q&A session with the questions that we've received from the participants beforehand. All right, a very brief introduction to today's speaker, Fadi Naffah. He's the program director at Beritech, which is the leading business and innovation center in Lebanon. He's a business strategist, a mentor, a coach, has more than 15 years of international experience across different fields within fostering entrepreneurship. He specializes today in working with companies in the field of growth strategy and tech innovation. And he's also a mentor at the World Business Angel Investment Summit, dedicated to helping startups all over the world. He volunteers as well as a business consultant for the Stanford Transformation Program, which basically tackles the end of global poverty cycle through dedicated and quality business mentorship and coaching. So as you may see, Fadi is an extremely busy individual, so we're very, very happy to have him on board today, and we can't wait to hearing the tips and tricks that he'll be providing us. All right, so a quick introduction to InnoRate. So what is InnoRate? InnoRate is a EU-funded project under the Horizon 2020 program. Now, the main objective of InnoRate is to really try drive the move towards the development of a EU financial system in which innovative and tech-driven SMEs with extremely high growth potential have easier access to financing solutions required to grow and scale. And in order to do that, InnoRate developed a service platform that, in a nutshell, it links highly innovative SMEs on the one end with with investors on the other hand, and it does that through an objective and forward-looking technology and innovation rating methodology. InnoRate is being implemented by a total of 9 partners, which you may see on the screen right now. And actually, I had a very small 2-3 minute video that I wanted to show you, but in order to give as much time as possible for the Q&A session, I suggest I can send it to you as a follow-up in an email. And it's a really fantastic, a very short video that would really enable you to fully grasp the full objectives of the InnoRate project. Now, I would like to conclude this slides by mentioning that InnoRate brings innovation to finance and finance to innovation. And that is basically InnoRate in a nutshell. Don't worry, I'll be sending you more information about the projects on how you can register on the platform within the follow-up emails. All right, so now that we've covered InnoRate, let us look at some of the barriers that are currently being faced by highly innovative SMEs in Europe when trying to finance their business growth. And one of the main elements to consider when looking at these barriers has to do with the capacity of investors to assess disruptive and potentially market-creating innovations. And the question is, why is that? Well, firstly, innovations, especially within high-growth sectors, are characterized by high technological manufacturing and market complexity. And this basically leads to the assessments of these innovation requiring an in-depth technology and market expertise, right? And sometimes this translates to investors not necessarily undertaking these assessments due to the lack of expertise within these technological analysis, but sometimes time, right? In order to assess these innovations, it does take a significant amount of time, and sometimes this translates to highly innovative SMEs sometimes not necessarily receiving the required financing solutions in order to grow and scale. Second, data. Right, and data nowadays is crucial to anything, especially the data to facilitate the assessment of market potential, but also the risks involved with the innovations. Nowadays, as you all know, appropriate data is very hard to find, sometimes costly to access, or just simply missing. It is scattered across the internet and provided in diverse formats, which makes it extremely difficult sometimes to analyze. And sometimes data has either access restrictions or significant prices imposed on their use. And this is exactly where the InnoRate's project and its platform comes into play and tries to fill this gap. Our concept is very, very simple. We're developing a service platform aimed at supporting investors and lenders for screening, prioritizing, and especially financing innovative SMEs with high growth potential. So if you're an innovative SMEs, and there's, I think today's session, there's around 65 currently right now, InnoRate can help you with the following. One, we can help you better understand the potentials and risks involved with your innovative solutions. Two, we can make your prospects clear to potential investors. We can rate your innovations very, very easily via the rating methodology that we've implemented through our platform. We can mitigate the investors' perceived financial risks with access to quality and sure data, and reduce knowledge and sometimes the asymmetries and risks premiums paid by innovative project managers. And then we can get easier and faster access to suitable financing solutions. Right, so now that we've delved into some of the barriers that are being faced by innovative SMEs in Europe, and the solution that InnoRate as a project and the solution, the platform that brings to the table, let's sort of delve into the tips and tricks on how to get investment ready. Fadi, the floor is yours, but just quickly before that, I'm going to switch presenters. All right, Fadi, you have been made presenters.
Yeah. Okay. Thank you, Edward, for this nice introduction. Just give me a second to run my screen. Are you seeing the presentation from my end?
Yeah.
Okay, great. So thank you, Edward, for this introduction. I'm happy to be with all of you here to discuss getting investment ready from a little bit different perspective. So we're going to talk first about differing funding stage and the criteria that are looked for in each stage. Then we're going to talk about main 4 elements that investors look for at the first interaction with any venture. Then we're going to discuss how to present yourself so you can be perceived strongly from an eye of an investor. So let's start. As you all know, the funding stages, sorry. Do you still see? Okay, sorry. The funding stages goes as follow. We have the pre-seed, the seeds, Series A, Series B, C onward, and the IPO. And there's a very important component that's usually neglected by venture, which is the debt financing, loan financing. We're going to talk a little bit about each one of these stages. So let's start with the pre-seed funding. So here, the startup is expected to be in the stage of exploring the feasibility, start building their first MVP, doing the market analysis, some market testing softly, marketing plan, sales plan. And here, the first potential investor, it should, not it could, it should be the startup owners themselves. And we're going to see in a few why. Then friends and family who are really trust you and believe in your idea. At this stage, approximately, you need around 50K of funding. And in my perspective, I prefer not to talk about valuation because actually your funder, which are your family and friend, fund you based on the trust relation, on their trust that you're going to invest their money and give them some return. You don't yet actually have a strong proposition to have an actual valuation. Now, the second stage, which is now you launch your product, you are building traction in the market, you're getting feedback, you're validating, you're complementing your team, you're preparing your product to be industrialized, so you're moving to the next level. And you need seed fund to overcome the challenges that you're facing. Here we're talking about angel investor, accelerator, incubator program, also family and friend who's willing to continue supporting you. And in some cases, you can go crowdfunding. The amount usually of fund needed, it's up to 500K, and we can start talking about valuation, which can go between 3 to 6 million. In the next stage, which is Series A funding, investors expect from startup to have a working business model. You have a key team in place. You have scalable market, so you penetrated your market and now you're scaling, and you're developing further your product or service based on the feedback that you got from the market after you did your validation with the first MVP. Now we still have super angel investment and venture capitalist. We're talking about up to 15 million in funding, and your venture will be valued anyway between 10 and 30 million. Next is Series B and other series up to an IPO. Here, investors expect you to be scaling, but scaling linearly. So you need to reinvent your business model so you can scale linearly. Now you are increasing your market share. You built high quality teams that can deliver, and you're putting your company on the track so it can reach an IPO stage. We still have venture capitalists, late stage VCs that are interested, and we started talking with private equity firm who can inject big amount of money into your firm. The approximate funding goes around up to 30 million, and your startup is valued between 30 and 60 million. Now you overcome the fundraising and you reach a stage where you can go to an IPO. In an IPO, you need to have a growth-oriented team, so it's a complete growth-oriented team. You have a proper and stable financial statement, so your financial statements are very strong. You have strong corporate governance. You achieved a good market positioning, and your brand now is already known in the market. So definitely the investor are the general public who's going to buy your shares. We're talking about 50 to 500 million or more. And here we don't talk about valuation, we talk more about revenue. So if you are near 100 million in revenue, you are also near putting your company into IPO. Now the last pillar, which is usually neglected by most venture, which is debt financing, getting a loan to take your venture forward. The good thing about debt or loan, it's quick access to cash, so you avoid the long cycle of investment to get the money. You have an easier predefined exit. So all the terms are there in the contract. So you know exactly when you're going to end this relation and how you're going to end it. There's no involvement in your operation, and the reporting is very light. But on the other hand, the loan is expensive, so the interest rate is high, and it is cash intensive because you need to start repaying your debtor early on, not waiting for an exit. And it requires asset in terms of guarantees of the loans that you took. Now, since we talked about all these financing mechanisms, let's talk a little bit more about the more 4 components that make your venture attractive to investors. Here we're talking about the first interaction with any investor. So we're going to talk about the founders, the product, the state of your startup, and the exit. On the founder side, there's 3 golden combination. So if the founder team have one expert in the industries that you're going to service, one expert in the technology that you're going to use, and one expert in business, that's the perfect combination that's very attractive to investor. Nevertheless, if you're missing one of them, we can look now on the complementarity of your team. So you need to either complement your team before going to investor, or put in your plan that you already got in place a plan to complement your team based on the needed skills that are missing right now. On the other hand, your industry expertise, even if you're not a technical expert in the industry, if you are on a technology expertise side or on your business side, have you serviced the target industry before? Have you worked there before? Do you know the ins and out of the business? Okay. Do you have network in that industry? And finally, we talk about solving a problem that you were affected by. It's very important from an eye of an investor, especially when you're telling the story. If you suffered from the problem that you're solving right now with your product or service, that relate you and put more passion in the game, and the investor will you'll be perceived in the eye of the investor that you really know what you're talking about, because you suffered, you are in the client shoes. And the most important part here, as you can see the 4 picture in the slides, same picture, is as we talked in the pre-seed funding stage, did you put your skin in the game? When you present yourself in front of an investor and you didn't put any skin in the game, you didn't put any penny in your startup, you might be perceived by the investor like you're gambling with someone else's money. So that's very important to put in place, even if you didn't injected cash, but for example, you left your job so you can be dedicated totally to your startup. This is also considered skin in the game in front of investors. So these things are very important to be portrayed to the investor you're talking to. Next is the product. Do you really master your problem tree? Do you really understand your core problem, the causes of that problem, the effect of that problem? Do you really develop a solution that addresses the core problem, or it addresses an effect or a cause? So the investor, he needs to feel very strong about you owning the problem and the solution at the same time. So you're solving the core problem, because the core problem is going to give you a bigger market size, which is the second topic we're talking about. So do you have enough market size so you can sustain for the future, or your product or service is just a solution, a project that can last for 2 or 3 years? What about the lifetime of your client? Are they going to use your product or service for a short period of time, or sustainably for a longer period of time? What are your key differentiators? Why your solution is more important than other existing solution? Why the client is going to buy your solution, not other solution? How to position your product against other innovators that currently working also on solving this problem. Also, these metrics are very important when you're presenting your product or service to be perceived in the eye of the investor. Next, we're going to talk about knowing your stake. And this is a very, very common mistake with startups who are pitching to investors. A month ago, one of the startups that is in the validate in the pre-seed stage came to me and asked me to be put in contact with the VC because they want to raise 2 million euro round. I told them it's not possible. In the pre-seed phase, first, you don't need 2 million round. Second, you don't talk to VCs. They're not going to listen to you. They're not going to take you seriously. So it's very important for you to understand when you talk to an investor, talking to the right investor so you can be perceived in the right way and you can be heard, and hopefully you will land the first meeting when they will be interested to know more about your venture. Finally, the exit. At each stage of your funding stage, even in early stage, when the family and the friends are the one who's investing in you, they need to know how much they can expect in terms of return, when they're going to get it. For example, your family and friend, they might be interested to get it at the next seed round or at the Series A. How they're going to get it? Are you going to buy back their shares, or possibly the investor going to buy them out? And a very important pillar that need to be in place. Is it financial projection that going to back your exit strategy or not? For example, at the pre-seed and seed stage, you have very few financial. So we can build a stronger projection for the future. So the exit is going to be more built on trust relationship and the family and friend or the angel investor knowing you beforehand. While in Series A, you should have a very strong financial projection, at least for the next 5 years. So the investor will rest assured and get some sense of confidence that you will be able to know there because to go there because your financial makes sense, and he will be able to exit and get his money back with the profit he is planning to get. Now that we talked about the first two pillars, let's discuss how all of these elements need to be combined together so we can be perceived in the right way in the eye of your investors. There's a proverb that says, if one does not know to which port one is sailing, no wind is favorable. If you don't know where you want to go, if you pitch to 100 investors, you're not going to land any investment. And I've seen many startups, going that way. They start knocking on investors' doors. They are not lending even a meeting, and they start nagging that the market is not responding to their need, even though they have a great product and a great value proposition. So to solve this, how you need to be perceived in the eye of an investor. In the eye of an investor, you need to be perceived that you know exactly where do you stand right now, where your current status, you know where your next status should be, you know in details the route that you need to take to reach there, even though different routes exist, but you plan and you know exactly your route. And most importantly, you know the resources that you need so you can go from this state to your next state. And these resources will define how much investment do you need. And you need to be more accurate when presenting these resources. For example, you cannot say in the use of fund in your investment pitch, product development. Product development is great, but what are exactly the functionality that you're adding to your product so you need to spend money on? If you said HR and recruitment, that's great, but what are the exact skills or the exact profiles that you're looking for to complement your team? So you need to present yourself to the investor to be perceived strongly. You know exactly your state. You know the next stage that you're going to reach when you get his investment. You know exactly how to go there, and in details how the use of fund need to be in details, how you're going to use those funds, what are the resources that you need to go there. So I hope I gave you a brief explanation. I know it's fast, but I want to open more time for you, so your interactive Q&A. So now let's move and start getting the first bunch of questions.
All right, well, thank you. Thanks a lot, Fadi, for this very enlightening presentation. I'm sure all the participants really did appreciate receiving these tips and tricks on how to approach different investors. As Fadi just mentioned, when preparing for this webinar, we really wanted to try and give as much time as possible to the participants to ask us all the necessary questions so that we can really tailor the answers and to best your investment needs. And with this said, we have approximately 25-30 minutes to kickstart this Q&A. We have around 63 people on the line right now, so we're expecting to receive all your questions, which you can do via the question box on your screen right now. And as I mentioned at the very beginning of the presentation, we sent out an email to all the registrants asking them to send us their questions. And we're going to start off the Q&A with these questions. So Fadi, here's the first question. I'm struggling to find an investor suitable for my company. How can I find and get in front of more investors?
Okay, actually, we get this question a lot. The first thing that you need to do, you need to search for investors that work in your industry. For example, if you in the agri-tech and food innovation sector, you need to look for investor, angel network, VCs that already invested in a startup in that sector. So they are interested in that sector, so you can start approaching them. Work on your network. For example, EBN, it's a very good network. Attending presentations with EBN and with other network will open your eyes and will can connect you to more network when you can reach out and try to identify new VCs or new angel investors. We need to understand one thing, that the investment journey, it's not like taking a loan from a bank. So it's not like I put forward my application, it's going to be answered in 3-4 weeks and going to be fast. Any investment journey can take between 6 to 18 months. So you need to know that you might pitch in front of 50 or 60 investors before landing any investor that can that's interested in your venture. And this is a normal game, so don't get demotivated about it. This is the rule of the game. And this general rule that says like the 30-10-2 rules. So you need to approach 30 investors and pitch verbally your proposal, so you can get 10 investors that might be interested to meet with you and listen to what you have to say. Then, so you might get 2 out of them willing to move forward and might land you an offer.
Right, thanks a lot. It seems that patience is key, Fadi. Moving on to the next question. How can I convince investors to invest in my company when it is not yet making a profit?
Okay, that's a very important question, and it relates to the industries that you're in. For example, if you are in e-commerce, it's totally different if you are a deep tech venture working on a deep tech solution. So it's a different ball game. But the common thing is what we discussed in the last slide. You need to be perceived strongly in the eye of the investor. First, you need to understand where you stand right now. Okay, what does it mean? It means you understand your market. You understand the market that you can be a player in. You have a clear value proposition. Okay, you understand that this is what do I need to go to the next stage. You already depicted, for example, if you are still in the product development stage, you depicted all your cost structure. And you know exactly your cost structure in a very strong way. So when you present yourself in front of an investor, even if you are not making yet a profit, he's gonna be confident that he invests in you, he's gonna be able to return his money with the profit that he's looking for. So at the end of the day, what's the biggest concern for an investor is the ability to retrieve his investment with the profit he was looking for.
Thanks a lot, Fadi. All right, let's move on to the third question. What valuation technique is best for my company? Or even, what are the different valuation techniques that are currently out there?
Okay, that's a half-a-day workshop by itself. So, in brief, when you want to talk about valuation, you need to remember the following. The valuation game, you have 2 main axes. valuing your company based on your history or based on the future. Okay, valuing your company in a green field, so we have a lot of assumption, or an existing industry, so already we have a lot of historical data with other companies that we can compare to. This two axes is define the valuation methodology that need to be used in your case. For example, if you're a startup, okay, you develop your MVP and you have very strong value proposition and you have strong cash flow projected for the next 5 years. So the discounted cash flow might be very suitable for you. If your venture who's been there for 3-4 years, you already accumulated some revenue for the past 2-3 years. So comparative performance multiple might be suitable for you because we compare your history to what you can achieve in the future and we use a multiple. So there's no right and wrong answer, but it depends on your state. But the things that you need to keep in mind, as I said earlier, whether we're using your history or we're counting on your future to value the company, whether we're using assumption because this is a new green field, or it's an existing field, we already have other players, so we can use comparative with others, and we already have data available. On valuation, one key point that all the startup need to understand, also entrepreneur, the valuation is a starting point. It's not an end point. So what's the purpose of a valuation? Is to have an idea about the value of a company so you can start negotiation with an interested investor. But you need to keep in mind that the valuation exercise that you did with an investment analyst expert, it's not the end game. It's just a starting point. And my advice to any startup, at least with your investment analyst, let them use 2, if not 3 different valuation methodology and evaluate the pros and cons of each. Then you decide which one you're going to use to go in front of investors.
All right, that's quite clear. And actually, bouncing back on the valuation question, here's another one. How would you value companies who do not yet have revenue and companies who do not yet have profit?
I just mentioned right now, these two axes, if you don't have revenue and profit. So, for example, if you are a deep tech science in the healthcare, you're building a new machine or new innovation. Here you have a lot of data in the market. So this new technology, this new breakthrough can be compared to similar breakthrough in the health tech industry. Okay, point one. Third, you can use also the future projection because the industry is very well established. Okay, you can compare with other innovators and you can project, for example, if it's a B2B or if it is B2C, you can have a clear projection. So when you start launching your product, what's the financial status of your company going to be 5 years down the road? Then you will use the discounted cash flow method. Why? Because first, you're valuing your company based on future performance, not historical performance, because you don't have any revenue right now. Then you're using highly volatile assumptions. So you're assuming that you're going to be able to attract that much amount of market share.
All right, thanks a lot, Fadi. Bouncing back on the next question, how do I know which investment is right for my company?
Well, it depends. So it's not, at the end of the day, the investment game, it's not like you do ABC, you're gonna get E. It's not like that. It's very dynamic. So it depends on the status of your venture. Are you generating profit or not? Are you a health tech or a B2C commercial online e-commerce platform with a different new business model? Okay, which kind of investor you're targeting? So all these come into game. Sometimes you only need to get a loan. You don't need to get. Let me give you an example. I worked with startup like 3 years ago. They were developing a smart irrigation system with all of sensor IoT devices that are in the field, counting on renewable energy, all this kind of stuff. The guy had a perfect solution. He had a perfect design. He already validated in one farm. All what he needed his money so he can produce in mass and sell. He kept moving from one investor to another, pitching to angel investment, pitching to early VCs. He didn't land anything. When I consulted with him, I told him, like, your issue is clear. You only need to take a loan. You validate it in the market. You have a very high, hot potential client that's waiting for you to buy. You only need the cash so you can produce in mass, sell it, get your money, and pay back your loan. It doesn't need to have an investment. On the opposite, another company innovated a special food component that they cannot produce. They need to produce it themselves. They had a potential buyer, even with a letter of intent, but they need to invest in building a factory that can take them around 1 year, okay, before starting to sell their product. So in this case, a loan is going to kill you. You need an equity investor who can invest with you, who can wait for you to sell, and he's risking his money based on your future value, so he can exit and take his money back with the markup that he's intent to make.
Right, that's very interesting. Should I look for investors in countries other than my own, or even outside of Europe?
From my perspective, definitely. 4 or 5 years back till today, you're seeing much more global VCs and venture capitalists popping up, but they are industry specific. So it's very important to understand your industry, to understand the player in your industry. And there's a lot of event happening per sector, per industry. Try to attend as much event as you can, so you can know who are the venture, who are the funder, who are the player in that industry. And and yes, definitely I see, unless your market is very specifically to Europe or to your country, I say yes, you should target international VCs.
All right, thanks, Fadi. This is a question that we often get. How much should I ask for?
Well, that's for me very easy to answer. You remember in the last slide when you put all those tools? So when you know your next phase and you know exactly how to go there, you will be able to explain in details the resource needed, and the amount of investment is the cost of these resources that you need to take you from the current phase to the next phase based on the detailed route that you depicted yourself. And believe me, for the past 4 years, I watched more than 300 pitches, and only 5% of those pitches were able to depict in detail what I just already mentioned.
Okay, that's quite clear. Now, a question about pitching, and please note that we will be having another webinar specifically delving into the do's and don'ts of pitching. But I think Fadi, you would definitely be able to answer this one, since you've seen many pitches over the course of your career. Do I need to have an exit strategy in place? What documents do I need to provide for investors after the pitch? Cap table, financial statements?
Okay, well, it depends. First, what's the purpose of pitch? If we are talking purely, it's an investor pitch. So for you to land an investor pitch, definitely beforehand, you send, for example, a 1 or 2 pager investment teaser to the investor. So he was interested in your investment teaser. He gave you an appointment, so you do your pitch. The exit strategy, from my perspective, again, there's a lot of people that contradict and do not agree with me. At a pre-seed and seed fund, most exit strategy can be buyback, share buyback. So you as the owner, if you generated enough revenue, you're gonna buy back the share your family and friend or of that angel investor, okay, and give them the markup, or they will be counting on your next investor to buy them out. Okay, so the exit strategy, if you are an industry specific, and what I'm trying to say, it can play against you, because if you were perceived by the investor, okay, early on, that you're building something just to sell it and get make some amount of money, it's a bad point. Okay, it's a bad point, because the investor need to rest assured that the team is going to be there until they deliver what they want to deliver, and they are passionate about what they're going to deliver, but they don't want to keep it to their own. They're willing to share with others. Okay, so I would say the exit strategy depend on the level, at which stage in the investment process you are, and the stage of your startup. For example, if you're pitching for Series B, definitely you need to talk about, you need to detail even your exit strategy, because your investor need to feel very confident that you really know your business, you know your industry, and you not just need this money so you can continue your exponential growth, so you can release your company, for example, a public listing, doing an IPO.
Thanks, Fadi. I see there's quite a lot of questions coming in with participants interested in getting the slides and having asking questions if the session is recorded. The answer to that is yes, the session is currently being recorded, and of course you will be able to have the slides. Actually, please, I suggest for you to go on the InnoRate website within 1 or 2 days, where we'll be uploading the webinar over there. So please go on the InnoRate website where you'll be able to access this recording. All right, so moving on to the next question. I think this is quite an interesting one, Fadi. Is there a right time of the year to seek investments?
Well, if you're seeking a loan, if your venture case is a loan, yes, definitely. The last quarter, November, December, is going to be a very tough time. You need to come in February, for example. But if you're seeking an investor, there is no right or wrong time. Why? Because the investment process is very long. You don't, even if you start a contact with an investor today, okay, you did your first pitching today, and if he's interested, you're not going to close it and get the money before at least 6 months down the road. Okay, so from my perspective, there is no specific peak or high time of the year where the potential, where the investor have more potential to invest. You need to start the investment. You kick off your investment process as soon as you are ready, as soon as you have all your files in place, because it's going to take you some time before landing any investment.
That's quite clear. And actually now is a question that's very current to the situation we've all been living in. So how can I make myself more attractive to investors in the time of COVID-19?
Seek the opportunity in the crisis. That would be my answer. You need to seek the opportunity into crisis. I saw a lot of startups who were really affected by the COVID-19, and I see other startups who were able to identify an opportunity in what's happening, and they're moving forward. For example, one of the startups, they were working on, any person with diabetes, they always have to do continuously some tests. So they were working on a very pocket size equipment, and based on sweat analysis, without picking the hand and getting a drop of the blood, can analyze the diabetes sugar level. Okay, and they were like still working on it, but when COVID-19 came, they put on hold that project, and they started using all their skills, started working on rapid PCR test. model, and actually it's going to release the rapid PCR test in the next quarter. So you need to see this opportunity in what's happening. You need to identify your core skills. So they have skills in product development. They already know the healthcare system, so they were able to jump in. Another also very interesting startup, they used to play in the hospitality sector. You can book a restaurant, book hotel, or whatever. And now, since with COVID-19, you have a very strict measures that need to be taken. A restaurant cannot be fully occupied; it needs to be 30 or 40% occupied. Directly, they grasped the opportunity. They added the model to the booking application, where you can, in detail, manage the booking, manage the occupancy of the restaurant. And now they're not only it's a B2C, now it's also B2B. So now the restaurants are more interested for paying to that application, so they can be able to manage their customer inflow and outflow and be able to be compliant with the strict measure put in place by the state.
Okay, moving forward with the next question. I'm really happy to see so many questions coming through. This is very exciting. So thanks a lot. And we still have around approximately 15 minutes to answer as much of your investment related questions. So please do keep them coming. Should I accept an investment which I think undervalues my company? How about if they offer resources other than capital? Access to markets, network, human resources?
That's a very, very, very interesting question, because actually, maybe I should adjust this as a slide to add it. When you need to profile your investor beforehand, and when you profile your investor, the value of your investor does not lie only with the amount of money that he's going to give you. It lies with his network, with his past experience in the industry, if he's able to help you putting your product on the shelf, what are the resources that he's able to give you. So that's also considered a big part of the investment that he's doing. And I preferred always for any venture, especially in below Series B stages, to look for investor that can provide resources, not only money, because they will be a perfect fit. They will help you to grow. They will help you to go from one stage to the other, and they will be interested in your growth for a very simple reason, because your growth is linked directly for them getting back their investment with the margins that they were looking for. So definitely you need to go for it. Now for the first part, should I go with lower valuation? Again, it depends, and I will give you here two examples. One of the startups that I worked for, they innovated a very scientific discovery, okay? But they were students in their master years, like 22 years old. They invented something, they don't have access to market, they were not able to put it on shelf. So they were and they needed cash to continue the development of the innovation. Luckily, they were able to get an investment from someone who is a player in the market. But we did the evaluation exercise, all the stuff, what is best for them. Definitely discount cash flow was the best method for them, because they have very high value in the market, very promising future. But listen to his, owning 100% of zero is still gonna be zero, but owning 10% of a billion is 100 million. So if you are not able to take your venture forward, and your investor is a perfect match to take it, to help you take it forward and put your product on the shelf, yes, definitely you should accept. And again, the valuation is a starting point to start the negotiation. It's not like the investment analyst value my company as 12 million. I should be stuck there only looking for investor who will accept that the value of my company is 12 million. It's never happened. It never happens this way. On the other side, a different venture, they innovated also a new product. They were senior people with 15, 20 years of experience, the founding team. They met so many investors in the Middle East. They weren't convinced convinced by they got 3 or 4 proposals. They weren't convinced by any proposal because they were always kept getting their valuation down. They took their company, they bootstrapped, they took their company from the seed stage to Series A stage. Then they were able to land directly Series B stage because their product were already on shelf. They had 3 years of revenue, so they were much better positioned, and they got the investment that they were looking for.
Great. And does that mean that all investors offer resources and support or help when trying to grow a company, or will they only strictly offer financial resources or support?
You have both. You have both. You have both types. It depends on your needs. It depends on your needs. For example, as I said before, you've been there for 3 years. You did it. You made it to the market. Okay. Now you need to build another factory in another continent, another geographical location, because you penetrated that market and you have a huge market and you're able to make it. So in this case, you need an investor who's only able to give you the money so you can build the factory and start servicing that market from a local factory instead of continue shipping goods from your motherland. So in this case, you've already been there, you have the network, you're able to sell, you understand your market. An investor who's only can provide you cash is suitable for you. Okay, so it depends on the stage, but usually up to Series A at least, you always look for an investor who can provide you resources and industry expertise, not only the money.
Okay. We have a company here who's attending the webinar who is preparing for a late seed or early Series A next year. What is your opinion on obtaining a strategic investor instead of a VC? Is the approach different?
It's not. It's the interest of the investor is different. A VC usually he's investing his money in your venture only to get a very good return because he believes that your venture is able to generate that return. A strategic VC will help you put your, he has the industry expertise. It will help you put that product on the shelf. It will help you with his network. So it depends. If that strategic investor have what you missing, you are missing in terms of resources, definitely a strategic investor is very good. I will give another example. As a similar situation, a seed startup, they landed strategic investor because they weren't able to progress without someone who's already been there in the market. And in less than 6 months, they landed Series A investor. Okay, so they use the strategic investor so they can grow the business strategically using the resource, the network, and all what he can provide. Then with his agreement, they landed another VC, and now the VC is the lead investor, and the company is doing very good.
Mm-hmm. Thanks, Fadi, for this. Moving forward, is having an in-house CFO an obligation, or would investor appreciate a CFO function executed by a specialist from an accounting office?
My perspective would be it's not that much important as long as you have a strong financial, as long as you what's the purpose of CFO, or whether he's in-house or from a company? It's to make sure that you have a very strong financial. So when you are in early stages, up to seed state, let's say, it's okay not to have someone in-house and outsource it. But if you remember, when we moved to Series A and Series B, we talked about the complementarity of the team, and we have like a growth ready team. Okay, so it depends on your stage, but a key pillar is, whether in-house or out-house, is to have a logic down to the dime, detailed financials that make sense. Especially you need to look after your cost structure. You cannot imagine how many times we worked with company where the cost structure was a complete mess, and we had to shift all the elements in order to have a much stronger financial to be presented to investor. So having a strong financial is the key. Even if you have an internal CFO, but when you want to pitch to investor, you need to get the help of professional people who their bread and butter is working with startup to make their financial investment ready, and they already been there. They done tens of company before you, and they will definitely be able to help you to better position you in front of the investor.
Sure, thanks a lot. I'm obviously conscious of timing, so if it's okay with all the attendees, I would like to take 2 more questions, and after that, if you feel you would like to get in touch with Fadi, I can obviously share his contact details with you. That is not a problem.
Sure.
But let's take two more questions. This is a question from Rosaline, who is asking, based on what does a company usually issue shares, number and prices of shares?
Okay, this is not this is not questions that can be answered directly, but this is after you finish all your investment readiness technical files. So you have the business plan, detailed financial, due diligence. The lawyer and the agreement, they will put the share, and they will divide them based on what you agreed in the term sheet, okay, in the term sheet, and when you're closing the investment. So how you divide them, it depends on the agreement between you and the investor. And remember that with time, you're going to be cautious about the dilution factor. For example, let me give you an example. Now you own 100% of your company, okay? At seed stage, for a seed investor, you gave 25%, and now you own 75% of your company. When you move to Series A, when the first institution, first VC want to invest in you, your shares and your investment, seed investor shares is going to be diluted. For example, now you're going to own around 55%. The seed investor go down from 25 to 18, and the institutions, the new investor get 25%. So these are very dynamic, and they are not as much important as the strategic investments that you're making. So my point is, like, put all your effort to find your strategic investor that can help you grow. Then those number, it's a matter of expert doing the exercise, not more.
Mm-hmm. Thanks, Fadi, for this. And taking the last question, this is a question coming from Wolfgang. We have a technology which did not exist before in a very important field. It's the microbiological quality of water. It is very difficult to present a realistic potential of the technology and compare it with other technologies, as nothing like this exists. How can we solve this issue? And before, Fadi, you being able to answer this question, I would really like to suggest for Wolfgang to actually go on the InnoRate platform, register, and do the pre-screening and deep assessment, because with this and with the help of our experts, you'll be able to retrieve all the necessary information and have a rating of your innovation potential, right? Which is going to be crucial for investors. So I would really suggest for you to actually go on the InnoRate platform and conduct the pre-screening and deep assessment function on there. Fadi, do you have anything to add here?
Yeah. If you remember when we talked previously about valuation method. So as I understood, if I understood correctly, it's a new innovation, it's a green field, it's not serviced before, okay? So we're talking about something futuristic, so you need to be valued based on future, not based on your history. And on the second axis, we're talking about something with a lot of assumption on the market, but you already have a lot of innovation in health tech, in green tech, in renewable energy. So you can look at those innovations, how they grow, and you can use your comparative method. Google, the key term, growth multiple, okay? Google growth multiple, and read about it. It might be a good solution to value your company. Okay.
All right, thanks a lot, Fadi, for such details and interesting Q&A session. I really strongly believe that all the participants really appreciated us taking as much time as possible to answer all these investment related questions. All right, so just before concluding this webinar, one of our partner project, Investor Horizon, is currently recruiting a new cohort of companies. The cutoff date is every 3 to 6 months, and the next cutoff date is November 2nd. So if you happen to be a deep tech company or entrepreneur seeking to raise Series A funding, please go on their website. And you can start your application directly. And this concludes today's webinar. I would like to thank all the attendees for sending us all these questions. This really made the conversation very dynamic and very interesting for everyone, I hope. Fadi, a massive thank you to you. This was very enlightening presentation, and we learned a lot. Just a small note here, please do follow us on our social media channels. It's Facebook, Twitter, we have a YouTube channel as well, and on LinkedIn. If you want to receive more up-to-date information about our upcoming activities, if it's webinars or workshops, there's a lot of activities that are currently being planned, so very exciting times ahead. So a massive thank you for everyone, and this concludes today's webinar.
Thank you, Edward. Thank you, everyone. Ciao.